So good morning, everyone. I hope you had a nice break. And like for all lectures that I hold, I want to welcome you. If you have any questions, anything which is unclear, let me know. Otherwise, today we are going to talk about portfolio management. So you should think about there are different ways to manage a portfolio. If someone in industry talks about portfolio management, they most likely talk about what we cover today. And that's the idea, or that's a concept which is known by different names. One name is Mean-Variance portfolio management, or strategic asset allocation. Another approach, or another name for the same approach, is Markowitz. And it has to do with the fact that Markowitz, a researcher, has come up with a way on how to systematically, efficiently, and optimally find portfolios. And he basically will assume that we as investors, we like to earn high expected returns. That is the name mean here. And at the same time, the investor doesn't like to take on variance risk, so which means variations in returns that we cannot predict, which is the variance. So therefore, most likely the approach is called mean-variance approach, if you come across that in industry. And that's what we want to talk about today. And I have a combination of some slides which I used, or which I had been using when teaching the MBAs at Columbia University, and I also connect that with a case study which you have access to in order to visualize what are we talking about here in practical terms, so that you can relate back to how that would be applied in industry. Good. Now here's the case study that will guide us through both sections today. Now, in our first encounter of the case study here, let's look at the picture, because that contains a lot of information regarding portfolio management. In a simplified way, it depicts what an investor is confronted with when deciding how to build an optimal portfolio. So think about here, you have different assets you could invest into. That could be a bond, either directly a treasury bond, or more likely a fund, an exchange-traded fund, ETF, which invests into bonds. Then you can think about an ETF on commodities, or on foreign equity, on US equity, and on real estate. Now the first step in this Markowitz portfolio allocation or mean variance allocation is you first want to create such a picture, either visually or via a table. And you want to display the standard deviation of the return in contrast to its expected return. Now Markowitz, when he came up with that approach, he assumed that expected returns and the standard deviation of returns are known. Now, in the age of machine learning, you see where machine learning can directly connect to portfolio allocation. It is exactly in determining these quantities. But for now, and for today, we assume them to be known. So we have these few dots. And now the question becomes, how should I allocate my money between all of these dots? And Markowitz, as part of his PhD thesis, being trained in operations research, he kind of did write that as a problem that we are going to talk about today. And basically, the outcome of his solution approach will be something like this line, the blue line that you see here. And later we will call that the efficient frontier. That will basically contain portfolio combinations of these assets that have a maximum diversification benefit. It just means, if you compare with bonds, for example, if you invest 100% in the bond fund, you could do much better if you did build a portfolio. The holdings are not displayed here, but you could build a portfolio that has the same standard deviation or the same volatility as the bond fund, but promise a much higher expected return. Instead of 5%, roughly 10%. And why is this possible? Because of diversification. We've been able to reduce the risk by grouping assets, by grouping our funds into different assets. And we are also participating on the premiums which US foreign equity, commodities, and the REITs are paying. So this will be the task of today, to understand where this efficient frontier comes from. And in the case itself, it's about it's called Partners Healthcare. So it's a system in Boston where different hospitals are joined together for a few tasks which they share, and one of the tasks is managing of the assets of these hospitals. And the goal in this case study is that Michael Manning, the Treasury Deputy or the Deputy Treasurer, he has been asked to analyze whether the existing portfolios should contain real assets, like here these REITs, and or commodities. Because as of now, they are only investing into US equity, foreign equity, and long-term bonds. And the question becomes, could they improve the portfolio holdings by moving into these real assets? I on purpose now have a non-technical language, and now throughout the class we want to understand how to translate the problem into a more technical language in order to also then find the solution to the problem. Yeah? Now, to start off with, the current optimal mix of risky assets that the Partners Healthcare is offering, which is this purple line here, it has the following mix. It has 55% domestic equity, so it's a US healthcare system, so it's US equity 55%. They go 30% into foreign equity, so that would be like German, European, Asian equities. And then long-term bonds, these are US bonds for them. And 0% you see in REITs and in commodities. So could they do better? We have to define what means better by including here the REITs and the commodities. Okay, so that is the case study. That is giving us a picture of what to think of and some background information about this healthcare. I've mentioned that. And here, in terms of investment strategy, what's interesting is that I think it's representative to other firms how healthcare, Partners Healthcare is organizing the investment funds. So you have to think about that at the end of the day, they have two types of funds. One is called STP. It's a short-term fund which they manage internally, and it's basically investing into fixed income instruments up to maturity of 2 years. In the textbook and our conceptual explanations, we will talk about a risk-free rate. And you see here in industry, they are proxying that risk-free rate by short-term bonds, which they actively trade in themselves. When it comes to investing into risky assets, these US foreign and long-term bonds, potentially also real estate and commodities, they are outsourcing that to 30 asset managers. Yeah. Why 30? I don't know. There's no information on that. We come back to this point today when we talk about diversification. Okay, so that's kind of the idea. So what's the problem in the case? Well, first of all, the question is whether the LTP, so the currently optimal mix of risky assets according to the Partners Healthcare system, whether they should include REITs and commodities moving forward. Now, the next problem in the case is to understand what is the optimal asset mix, because whatever Partners Healthcare has been doing might not have been optimal. So there's a way to check, is it optimal? And if not, how much is it away from optimality? Then another problem is, since different hospitals are basically outsourcing their asset management decision to this Partners Healthcare system, the question is whether each hospital should have their own optimal risky and this short-term fund, or whether there's one portfolio for everyone. Good. Now, let's connect back to where we are in the course right now. Think about 3 pillars which will be of relevance to us for today and maybe also for next week. Now, the first pillar here, expected return, is something we did talk about last week. We've talked about a case study and additional conceptual materials about how to think about the risk premium. Now, we talked about the real risk premium basically because we think about that the risk premium is free of inflation. Now, if you add to that the real risk-free rate and expected inflation, you really get to the nominal expected return of a company. Now, today we want to start thinking about what's the risk when investing into a company or into any other project. And for us, risk will be the variance of future returns. Yeah, so it's this quadratic expected dispersion around the mean. Also, we will learn that it's not only the variance of the individual returns, but it's also the correlation of individual asset returns with the market return. And why that's the case, that's exactly what we cover today. And the third pillar is basically a decision criterion. Once you have expected return, once you have risk, the question becomes how to combine assets in an optimal way such that I can say I've really done a good job in building a portfolio. And that is also something we talk about today, and we will use the Markowitz approach or this mean-variance approach to include the information about the mean of different asset returns and their covariance matrix, basically from here. Good. Now let me start with a punchline, so you really see what's going on before we dive into details. Now, the Markowitz portfolio management approach, again, it's what's also called mean variance, and as a rule of thumb, 90% of industry talk related to portfolio management relates to Markowitz approach. And the other 10% are variations of it. So the insight of Markowitz, for which later he then also received a Nobel Prize in financial economics, is to show that portfolio management is basically a 2-step approach. Even if you have 1 million assets to invest into, it all boils down to 2 steps or 2 funds. Now, the first thing is you want to find out of all risky assets how to combine these in order to get the maximum Sharpe ratio. So what is Sharpe ratio? Now, the Sharpe ratio is defined to be the expected risk premium divided by the volatility of your portfolio. So if we go back to the case study to guide us here, the Sharpe ratio will be basically, if we think about this be the risk-free rate here, 4% by assumption, the Sharpe ratio will be the slope in this 2-dimensional graph, because we are increasing on the y-axis in terms of the risk premium, and we are dividing by volatility. So the question of the first step in portfolio management will be, can I combine all these risky assets? Yes, I can combine, but I want to combine them to get the steepest connecting line, the steepest slope. And if I found that, this will be my optimal risky portfolio. Now, in the case study, in their own decision making, we see that what they have been doing with their risky portfolio is not too bad. We don't know it's optimal or not, but at least we see the slope is larger than if we were to connect any single dots with the risk-free rate, which I assumed here to be 4%. And later we will see that, or I can already mention it now, that the optimal risky portfolio, it needs to be on this efficient frontier. Yeah, so therefore the LTP did already pretty good. So this is the first step in the portfolio allocation. Find the optimal mix of just risky assets. This will be called the LTP in the case. In a textbook, it's also called tangency portfolio. It's also called maximum Sharpe ratio portfolio, so different names for the same concept. And once you have that portfolio, this optimal risky portfolio, in the second step, you're now going to check for what's the risk aversion of your client. Like in the case, it's about how much risk does a hospital want to take. And the more risk it wants to take, the more it would allocate funds into that optimal risky portfolio. The lower the risk aversion of the hospital, the lower the share that goes into that optimal risky portfolio. And what about the rest? The rest always goes into the risk-free rate. So if we go back to the case study picture, what Markowitz explained first to the academics and then they later to the profession is that the optimal approach for portfolio management would be consisting of two steps. Step number one is, out of all of these risky assets that you can invest into, find the single combination with the highest Sharpe ratio. That will give you a straight line. And now, in the second step, based on risk aversion of the investors, find your position on that straight line. Right? That, in a nutshell, on a high level, is what the Markowitz approach is all about. And we will now add details around that punchline statement. Now, the final portfolio then for each hospital is also called, in the textbook, optimal complete portfolio. Yeah? So, okay, now we start to characterize a Markowitz investor. And I think the most important is usually what I have in red boxes. Here I have the text to something related to the red box. So I want to talk about this red box here. Now, that characterizes how Markowitz thinks about an investor. Now, if you make a portfolio decision, of course, at the end of the day, you see what's your realized return, and either you're happy or you're not happy. But it's ex post. Decisions are made ex ante. And therefore, ex ante, that's how we conceptually think and calculate although it might be difficult to estimate in reality. So very typically for financial economics, we assume there's a utility function. And the utility function depends on the portfolio decision. Here I've been writing it as RC, but RC is the return on the complete portfolio, right? So it depends on the portfolio holdings on which you decide on today. And now Markowitz says, let's assume the investor likes, therefore we have a positive sign here, if expected returns are large. I think this is very universal. The higher the expected return, the more we like the decision we've been doing. On the other hand, you see there's a minus here. A is positive. This will be risk aversion of the investor. So we think about that to be bigger than 0. And the variance by construction is also positive. So you really see that your utility is falling if the variance of your portfolio return goes up. Now that's the reason of why we call a Markowitz investor also a mean-variance investor. Because such an investor, he only cares for what's the mean, what's the expected return, and he also cares about what's the variance of my return. He or she does not care about skewness, kurtosis, crash risk, and the like. Right? That's why a mean-variance investor. Okay. Now, risk aversion, A, is something which is very specific to either a person or to the hospital. It's nothing to optimize over. Right? It's exogenous to the problem. If you ever opened an investment fund with Vanguard and others, they usually send you a questionnaire around to pin down what's your risk aversion. It just shows you how prevalent that concept is in industry. Okay, now let's go back to this red box from a visual perspective, which I have in these other two red boxes here. So let's go to this one. Now, what it displays is basically on the x-axis we have again volatility, so that's the standard deviation of the return, and on the y-axis we have the expected returns. And what you see here now, let's start with the bottom one, is this dark blue line. Each of the lines are called indifference curves. So it's something related to indifference. What does it refer to here? It gives us different risk expected return combinations that all provide the investor with a utility of 0.04. So that's the first important takeaway. Even, let's say you are highly risk averse, so you think about, I don't want to take much risk, so I'm down here. What you take away from the picture is you would be as good off with a highly risky portfolio, let's say of 25% vol, if simply the expected return was sufficiently high. If you're new to investments, that is really something to think about, that there are different risk-return combinations that you would feel as happy with. Now, the next thing to take away is you would like to feel as happy as possible, meaning you would like to have a utility which is as high as possible. So you would like to move along this red arrow, because the higher you move, that is what's indicated by the numbers here, the bigger is the utility. And it's also pretty intuitive. Let's say you start off with a 10% volatility investment, and the expected return is somewhere at around 5. So the utility you would get is 0.04. Now, if for the same amount of risk, you find an investment that offers you 17% expected return, it's much better. Same risk, higher expected return, you feel more happy. And that's exactly what the utility function is capturing. Right? In this example now, I kept the volatility, so the square root of variance, fixed at 10%, and I simply increase the expected return, which then also increases my utility, or your utility in that case. And here's a table which provides a few numbers for exactly what I've said. So we could assume risk aversion be 3. Now here we compute the utility of the investor, and we are varying the expected return and the standard deviation, which we then square here. And here I'm plotting 1, 2, 3, 4 combinations of risk and expected return, and they all result in a utility of 0.1. So they would all, if we zoom up, 0.1 is the green line here. Yeah, and here, while this is a continuous line, the table provides 4 points on that line. And these portfolios are really different. If you are exposing yourself to 5% vol versus 20% vol, that's a different portfolio, definitely different. Keep in mind from last class, what I like to do, I multiply the volatility by plus minus 3. So I roughly have a 99% interval, ignoring the expected return here. So here I will have unexpected variations of plus minus 15%. Here plus minus 60. That's a big difference. But interestingly, the investor would just be indifferent between these two assets if also the expected return for the high volatility asset would be 16% instead of 10.38. Okay. Now, the last box I'm showing here are indifference curves when risk aversion is increased. Now here risk aversion is 10. If you go back to the mathematics of it, you see if A is now 10 instead of 3, the penalty term is 3.33 times larger. Right? So intuitively, it already tells you if you want to stay on the same indifference curve and you're increasing risk by 1%, the expected return has to increase more 3.3 times more than if risk aversion was 3. And visually, you see that here. You see that these indifference curves are just steeper. As you increase volatility and you want to stay on the same utility level, the expected return that is promised needs to rise exponentially. So that is the way you can visualize yourself a highly risk-inverse investor. Yeah, it's an investor who would go into the market if the expected return promised would be really high. Good. Now, going back to the case, in the case study, we have different hospitals, so most likely we have different risk aversions, right? You could think about there's one hospital which has a rather flatly rising indifference curve, so that would be a low risk averse customer. And you can think about it as another hospital for sure, which has a high risk aversion, and they would have a very steep indifference curve. And then the question, the case is, how to find portfolios for these different hospitals? And that is what we are doing today. Good. Now that is what everyone knows in industry, and let's move on. Now, I've mentioned that portfolio allocation is a two-step approach. And I will start now with the second step. Right? That step is a bit simpler, so I like to start off with that. So we basically assume that we already know what is the optimal risky portfolio. So we know what's this tangency portfolio. And we will now ask the question, how much shall each hospital invest into that optimal risky asset, and how much into the risk-free rate? So I go back to the case study picture to visualize what we're doing here. We are basically, for now, assuming LTP is the optimal risky portfolio, and we know it's given to us. We will assume a risk-free rate. We make a linear connection between these 2 points. And now you see the indifference curves. We will try to move them as high as possible until they still touch that straight line. And if on this point of tangency where they touch, we found the optimal portfolio of a hospital, and that is what I want to formalize here, basically, that step. Okay. To keep it simple, I also introduce all the notation, and I put numbers into expected returns and variances. So Y is the fraction of wealth that that the hospital invests into the optimal risky portfolio. So think about it, could be between 0 and 1, it's 0, 100%, but could also be negative, so we talk about that. For now, there's no constraint on it. Then we work with a random variable number here. N stands for a Gaussian random variable with an expected return 9%, a variance of 0.04. If you take the square root out of that, you get 0.2. So that's the 20% volatility. I'm kind of assuming unconditional numbers for a market index. Yeah, I mentioned it yesterday, last week, roughly 10% expected return on an index with a 20% vol. Now then, variance RC will be the variance of the complete portfolio. Sigma C is the square root of that. That's what we call volatility. Then ERC is the expected return. Here we have the utility the investor gets from the complete portfolio as investor's risk aversion. And then if we have R with this index TP, that's the return on the tangency portfolio. So in the case it's called LTP, also interesting name because TP is the textbook naming, so LTP is pretty close to the textbook. So that's the optimal risky portfolio's return. It has a mean, which is here. It has a variance. It has a volatility. Then RF is the risk-free rate. That is what you get if you put your money in your bank account, basically. That's the way you could think about it. SR is the Sharpe ratio. So it's defined as expected excess return per unit of volatility. Or in industry, we would say it's the risk premium over risk. Knowing risk means volatility here. Okay, and just keep in mind, sometimes you see pictures where risk on the x-axis is in terms of volatility, sometimes it's in terms of variance. It depends a bit on the message one wants to bring across, but variance and volatility are just transformations of each other, so the information is the same. It's about the dispersion of realized returns around the mean, so these are things you cannot predict. Good. So for the moment, we're going to assume that the tangency portfolio has an expected return of 7% and a volatility of 20%. Okay. We assume a risk-free rate of 2%, and so now comes the first equation here. We say if we invest Y, I put a percent on it so you can visualize it better. If we have Y% invested into that optimal risky asset, then 100 minus Y% needs to go to the risk-free rate. And the realized return will look as follows here. So the return will be a realization of a random variable. That random variable will have a Gaussian distribution. It will have a volatility, and you see the volatility here is Y times 20%. Because if 0% go into the risky asset, then the vol is also 0. If 100% goes into the risky, you have a 20% vol. And otherwise, you have Y times 20% as your vol, and then we square it to get the variance of your portfolio return. So on the other hand, the expected return, if you invest everything into the risk-free rate, so Y would be 0, 100 minus Y% would be 100% or 1, we are down here. Yeah? So if Y is 0, you're simply earning the risk-free rate. On the other hand, if you invest 100% into the risky asset, then Y is 1, so you get 7%, that's the return on the tangency portfolio in expectation, plus 0 here, because 0 investment in the risk-free rate. And otherwise, if you're somewhere between 0 and 1, or your Y is even negative, your expected return moves according to this linear combination here. Y times the risk premium plus 1 minus Y, the risk-free rate. So you see already here also that the risk premium is important, and also the variance is important. Risk premium we talked about last class, and now this class is about variance and the portfolio allocation setting. Good. Now that is now what each hospital would know, but the hospital still doesn't know what I'm addressing down here, which is how much should the hospital invest into that tangency portfolio? Right? I'm using a slightly different language. Again, use a bit of jargon here. How much to invest into the 5% risk premium asset? Because the tangency portfolio has a 5% premium, so another naming would be to call it a 5% risk premium asset. Out of the context, it's clear since we only have one asset, which we are talking about. So we basically just don't know, should we invest 10%, 50, 100, 200, or should we short the asset, have a minus position in it? And for that exactly we now need an objective function, which we then optimize relative to these Y's. And this is going to come. But before, just again a visualization. That is in the second step of portfolio allocation. We assume the optimal risky portfolio is known, like the LTP in the case. We assume the risk-free rate is known. We can connect them in a linear line. The line is called capital allocation line. Why that? Because we will see as we move on, there are no returns above the allocation line that the market offers. The most efficient one are exactly on that allocation line. But that comes with regard to the first step. In our second step here, the question will be whether the hospital should find an allocation y equals 0, y equals 1, maybe y equals 2, or any other combination for y versus 1 minus y. And the picture is to highlight that each hospital will really just position themselves along this straight line. So if you have someone who's highly risk averse, they will be somewhere down here. If you have a hedge fund who are not risk averse or just a little bit, they will somewhat be here. But they will all be on the same line. They will be exposed to the same Sharpe ratio. It's just a matter of risk aversion where they end up at the end of the day. And we are reiterating this point a little bit, and then it culminates into a little calculation which we do. Now we are now combining this allocation line with the preferences of the investor, this mean variance preference. Now, what I tried to draw here, the picture, the shadow here doesn't have a meaning. I've been drawing two investors. One has risk aversion 2, and the other one has a larger risk aversion. So I wanted to have just in one picture what it means if two investors, or two hospitals in our case, have two risk aversions. Yeah? If they are not investing into risk, I'm here assuming they both get the risk-free rate, and then in order to, so they are on the same indifference curve, and in order to stay on that same indifference curve, you have to promise more expected return to the higher risk-averse investor relative to the lower risk-averse investor. Okay, but both of them will increase their utility, how much they like the investment if they can move up here. Okay, and that combination comes on our next slide. But for now, keep in mind, that's the indifference curve characterization in terms of the math. Investors like high expected return, they dislike risk, stated in terms of the variance here. And Y will enter through RC, because RC will be the complete portfolio, which is this linear combination of TP and 1 minus Y into risk-free rate. Okay, now here's the picture, which I did refer to. Now, in that second step, we already know this capital allocation line, and all investors, all hospitals want to go as far north west as possible. So if they're down here, they could do much better. Yeah? For that amount of risk, they could get higher expected returns if they move up here. If they're up here, the market doesn't offer that trade-off. So you see that the optimal point of tangency where the indifference curve touches the allocation line is the point of optimality, because that provides the highest Sharpe ratio. So this steepest trade-off between expected return and volatility. And it then just happens if you have a low risk averse investor like here, the point of touch will be further to the right, and an investor which is highly risk averse will touch the allocation line further to the left. But you again see the Sharpe ratio is the same, right? So in terms of skill, how good are they? They will be as good, because premium per unit of risk is the same. Yet expected returns and vol will be different, but that is so because their risk aversion is different. Good. So let's just recap what we've said so far. Now, we've been talking about the second step of portfolio allocation, and in that second step, it's about the investor, and it's about that the investor has risk aversion. And that's why the investor trades off expected return versus risk differently. And it's that risk aversion which controls the trade-off. Now in the second step, we also have the capital allocation line given, and that allocation line provides the best expected return risk trade-off that the market offers. How to get there, that's the first step. But in the second step, this one is given. And what we are doing here is now every investor is going to find his or her complete portfolio as the point of tangency where the indifference curve, this convex curve, is touching this linear allocation line. And the slope of the allocation line is the highest Sharpe ratio that you can earn in the market. Okay. Now here's everything we've said so far in terms of a little mathematical application. Good. So we know that the investor wants to maximize his or her utility. And we know that the utility has this expression here. It's the expected return of the portfolio, ERC. And we know it moves along the allocation line, which is a straight line. So therefore, the expected return will be y times the expected return of the tangency portfolio plus 1 minus y, the risk-free rate. Now, the second determinant of the utility function is risk. It's that penalty for taking on risks, which also moving along the allocation line, which is a straight line, characterizes risk of the complete portfolio as being y, so the amount, the wealth, the relative wealth that goes into the risky asset, power of 2, times the variance of the tangency portfolio. And again, the tangency portfolio coordinates in terms of variance and expected return, they are known in that second step. A is the risk aversion of the investor, so we keep it as an A. Now there's a half in front of it. This is just for mathematical convenience. And you see why. And you see the reason for that coming up now. So now the investor wants to find the allocation Y that is maximizing the utility. And you see mathematically this is a very nice optimization problem to solve because the Y is showing up here quadratically. So if I take the first order derivative with regard to Y, the exponent 2 comes down, it cancels off with the 1/2. That's the reason why the 1/2 stands there. So that you don't have a 1/2 or a 2 in the solution. Otherwise, the variance here is independent of Y, risk aversion independent of Y. If you make a derivative with regard to Y here, you see expected return survives, minus the risk-free rate survives. And that's what the investor is doing. Build first-order conditions, set the first-order condition to 0, and then solve for the respective Y. Yeah, so you can verify that at home, that the solution is then this red box. Red boxes in the course means it's very important. I want to say everything we cover is important. Red boxes mean you should, if you go for an interview, that is exactly what people want you to be aware of, ideally also to derive. So here we basically now derived the optimal Y. So it's the optimal point on the straight allocation line. And it has an expression, you see it the first time. It tells you not as much as it tells me. Now, to me, it's a very beautiful expression with a lot of intuition. Now, it says that you invest more into the optimal risky asset if the expected risk premium is rising. I think this is very intuitive, right? All else equal, if you get offered more expected premia, you go into this investment instrument. At the same time, you're also dividing by risk aversion. It's also very intuitive. Now, if risk aversion goes towards 0 from positive, it means you're less risk averse. So if you're dividing here by a number which converges to 0, Y goes up towards infinity. Now that characterizes a hedge fund in my thinking, right? Because the hedge fund doesn't have a big risk aversion, so they would like to take on as much of the optimal risky portfolio as they can finance. On the other hand, if you have someone close to retirement and they have little funds to invest into, their risk aversion will be pretty large, most likely. So you see, you divide by a large number, and then it's optimal for them to have only a little bit of investment into that optimal risky asset. And in the limit, if risk aversion goes to infinity, the position goes towards a zero. And then you divide by the variance of the optimal risky asset, which is also kind of intuitive. All else equal, if you get information that the market gets more risky, right? It gets more unpredictable without offering higher expected returns, then all else equal, you would reduce your investment into the market. Now, we can rewrite expected return over vol as being the Sharpe ratio. So the formula can be rewritten as the Sharpe ratio of the tendency portfolio. So that's the slope, basically, of the allocation line. And then you divide that by risk aversion over volatility. So if you were to plug in the numbers from my little example here, you would get a Sharpe ratio of 0.25 divided by a vol of 0.2 times risk aversion. So you see that the optimal position of that indifference curve along the allocation line is a function of risk aversion. Right? And risk aversion is inherent to the client. So whenever I think back about this Vanguard questionnaire, someone comes in, we don't know their risk aversion, the questionnaire tries to figure out risk aversion, and then we could find out what's the optimal point on the allocation line for that investor. So here's a takeaway of this last slide. In that second step of portfolio management, keep in mind the investor wants to invest in the highest Sharpe ratio asset, which is the tendency portfolio, and it will do so. And here I basically characterize this red box from previous slide. I'm saying the investor increases the allocation to the optimal risky portfolio if either information comes in or the machine learning makes a new forecast which you trust that expected Sharpe ratios go up, then you would invest more. Or you get the information that volatility is falling, then you would also invest more. Or the investor's risk aversion is going down. Good. Now that trade-off, if I go back, that trade-off between y and 1 minus y is also very prominent in the news. So you might have heard terms about flight to safety, flight to liquidity. These are terms showing up in times of crisis. A typical statement in the news could be the market has dropped as a result of flight to safety. And what that means is that something has happened such that it became optimal for a Markowitz investor to reduce the y. And if you reduce y, you are increasing 1 minus y. And 1 minus y is in the risk-free asset. That's the safe haven that the industry or the media then talks about. So it could have been, for example, that volatility has been rising, and as a result, that's why I said in terms of a crisis, it must be a dramatic shift in volatility. The typical investor is then moving down the allocation line into the risk-free asset. Not 100% of the funds, but maybe Y goes from 80% down to 70%. Yeah? This is the flight to safety, flight to liquidity. It's called flight to liquidity because these very short-term risk-free assets in the US are highly liquid, very, very liquid. So therefore, flight to Or sometimes you're reading in the news then something like risk aversion has been high today and as a result flight to safety. It's the same here. Yeah? So A is not observed, but the media is interpreting things, and then they are kind of interpreting that a news happened, which for reasons we don't model, increased risk aversion of the aggregate market. And if that happens, you would also reduce the share you invest into the tangency portfolio and increase how much you invest in the risk-free rate. So that game is very prominent and very often part of media coverage. And for us as investors, it's also pretty intuitive, right? That we are thinking at the beginning of a crisis, if we had a good machine learning tool and it predicts vol is rising, we are not the cowards to go out. It would be optimal, right? If we are predicting vol to go up, it just would be optimal to reduce the risk exposure, all else equal. On the other hand, if the crisis is at its peak, then volatility is starting to shrink again. And you see, according to Markowitz, if the vol is shrinking, we should gradually build up our equity exposure. Yeah, so these rules that you can derive out of this equation are very useful. And if an investor were to follow them properly by writing an algorithm, give it to the computer, they would make good investment decisions over the long term. Good. What we now want to do is we now want to talk about the first step of to-fund separation. And that step is about how to find that capital allocation line. Or said differently, how do I find the mix of risky assets that has the maximum Sharpe ratio? Good. Now, you should keep in mind there are different namings, different wordings for the same concept. So in what we're now going to do is we're going to find the optimal risky portfolio, which some people call, we want to find the tangency portfolio. So you see, like I also sometimes like to talk about the tangency portfolio. It basically has this graphical interpretation that we are putting a tangent line on the efficient frontier. But that is what we now do step by step. Okay, now there's a time now to also talk about why do we want to invest into different risky assets and not just invest, for example, into US equity. Yeah, if we go back to the case picture to make it very practical, I'm raising the question here that you might come up with, why not simply invest into this one here, which has the highest expected return? Why bother building a portfolio? And this has to do with risk, because you don't know that, or what do you know? You know over the next year, if returns were Gaussian, then your realized return would be 13% mean plus minus 3 standard deviations. So plus minus 45. So it's a huge interval basically. If that interval was 0, if you knew for sure you are getting 13% while the others for sure get only these, then yes, you would invest into the risky asset with the highest return. But in reality, because of variance, we don't know what's going to happen. We have a bit of an indication what can happen, but we don't know what's happening precisely. And that's the reason why diversification comes into the picture. And think about diversification like you have 100 eggs and you want to bring them safely to someone who wants to make an omelette or whatever out of these eggs. you would not put all these eggs in one basket and then start to run, right? Because for sure they would break, maybe not all of them, but a few, maybe even all. But what you want to do is ideally you put the eggs such that they will not break. And that's it's a comparison which is often used, so it's not my invention. And the underlying rationale or reason or talk is about diversification. So it's don't put all your eggs in one basket, yeah, as the Americans say there. So within the mean variance approach, we also now will see slowly by slowly that it's really optimal to do so. Because with the omelette example, it's not clear really why this is optimal. But here we will see. And the idea is the following. If we can diversify, we are reducing risk. And if we are reducing risk, you already see that the allocation line will get steeper because we are dividing by risk. So risk is of first order importance for getting high Sharpe ratios. Because if you want a high Sharpe ratio, you want low risk, all else equal. So diversification is very naturally coming into this picture. And we've seen by covering already the second step of portfolio allocation that every investor benefits if the capital allocation line gets a higher Sharpe ratio. And therefore every investor benefits from diversification. And now these charts I've taken from the Bodie Kane Marcus book, in case you want to have a look at an investment book. So the book is also called Investments, Bodie Kane Marcus. And the punchline here I've visualized already, which is if you cannot predict what is happening in the future with 100% certainty, then you would want to diversify. And from now on, you want to think about that diversification can be accomplished in two ways. One way is called 1/n rule. Sometimes it's called the naive rule. And it works very well, very good. And I show you evidence for that. So just highlighting because the name naive is kind of suggesting it's not a good thing to do. But it works very well in industry and it works well with financial data. So the idea with 1/n is, in the case they have 4 risky assets, if I'm not mistaken, or just 3, equity US, equity foreign, long-term bond, so they start off with 3. 1/n would say 33% into every instrument. There's also this old anecdote from these very old humankind books. There's the very old Jewish book which also talks about how to invest money, and they also say you should invest a third in that, a third in that, a third in that. So this 1/n is historically also kind of well motivated, and empirically, if you are interested, I can show you empirical work that these 1/n provide you with a very good diversified asset portfolio. I mean, what you have to think about, if I invest into one third Volkswagen, 1/3 Daimler, and 1/3 BMW, I'm not well diversified because my N universe is just the car industry. But if I take 3 firms out of the S&P 500, or even 3 firms out of the DAX 40, the resulting portfolio will already be pretty well diversified. And there's evidence for that coming up in this course. Okay, but this is not using any math, right? It's just 1/n. Now there's a mathematical approach to do, and we call that the systematic approach, or others say it's the Markowitz approach. And we will use that approach in the Python focus sessions. And when doing so, we then compute, let's say for BMW, how much of the BMW return volatility is systematic, meaning that co-moves with the market, and how much is BMW specific. And that BMW specific one can be eliminated if we put BMW into a portfolio of different stocks. Good. Now, we are staying in this area of decomposing risks. From now on, we want to think about that risk of a project, of a firm, has two components. One is systematic risk, also called market risk. So think about BMW. If now the market outlook is dropping, so we expect GDP to fall, unemployment rate to go up, we expect spending to go down, it will have an impact on how many cars BMW is going to sell and for which price, right? So that's this market element in the return variation of a firm. But then there's also the unsystematic part. So something that is unrelated to what the market is doing. This could be like, how innovative is the firm? Do they have any big scandals, like the diesel scandal, for example, at Volkswagen a few years ago? So that is also then called unique risk. And the way to visualize that is given here in these graphs. Now, on the one hand, you see on the x-axis you have n, so that's the number of assets in your portfolio. So if you only have one asset in the portfolio, your volatility will be here. If you want a number for that, let's say 50% volatility. And then you see as the number of assets increase in your portfolio, the volatility of your portfolio is also falling in that exponential shape. And it will not fall to zero. This might look like zero, but we did not specify the x-axis. Yeah? So it doesn't fall to zero. It flattens out in some point in time, both here and here, and it converges to, let's say, something like 20%. And that 20% would be the horizontal line here, and that's the market risk. It basically says, if I take my own funds and I'm investing that into 5,000 different stocks, I would still be exposed to, my portfolio would still have a volatility close to the S&P 500. Right? So I can never converge towards a 0% volatility by increasing my assets towards infinity. Realistically, that will not work. But we will converge to a plateau, and that plateau is the risk that we are exposed to if we want to invest in the market. So it's called market risk. But then let's say I invest in a portfolio of 10 assets, so I'm here. Then you also see my portfolio has a volatility which is higher than market risk. Let's say it's 30% versus 20 in the market. So I have a 10% volatility in my portfolio, which is unique risk. Right? It's portfolio specific. I could still diversify it further if I increased my number of assets. And while we do that here for volatility and variance, because Markowitz is about mean variance, for financial data science, I want to make the point that thinking also applies to any other type of risk. Would it be skewness, kurtosis, or probability of a jump? That thinking is very prominent in finance. That any type of risk we are looking at could be decomposed into what's the market risk, so that's the risk if my n goes to infinity, and what is the actual risk I have, and the spread is then my portfolio specific risk. Or if my portfolio consists of one firm only, it's firm specific risk. Okay, so here's the same graph now with a few numbers attached. Now that is from a research study, 1987. It's a very good journal, and the question was, how many stocks make a diversified portfolio? And what they found is they looked at an asset universe of 1,000 US stocks, And now by coincidence, they just pick one. And they do it several times. Yeah? So what they find is basically, if you just pick by random one stock, your volatility is roughly 50%. That's also a rule of thumb to keep in mind. That if you don't know anything about a stock, you should work with the unconditional forecast. The vol is 50%, 50. What they also then did is now they pick two stocks at the same time out of the universe of 1,000. And they see that on average, the portfolio had a vol of 35%. So if you go to the right axis, it says you could diversify 25% of risk by simply holding two stocks instead of just one stock. So you get a big reduction in volatility by simply diversifying a little bit. They kept on doing that. For example, if you go here towards 5 or 6, the vol of the portfolio was at 30%. So you had a reduction already of somewhere 45 to 50% reduction by simply holding 5 stocks. Now the other interesting thing is if you go towards 20 stocks or towards 100, the volatility is roughly the same. So the message is that you are plateauing pretty quickly. So having more than 20 stocks chosen by randomness does not reduce portfolio risk dramatically. So therefore it wouldn't make sense to buy 1,000 stocks in terms of diversification, because only buying 20 stocks gives you the same amount of diversification. There's an epsilon difference, but we say it's the same. And if you buy 1,000, you have 1,000 times transaction costs. And transaction costs are a fee. It's expensive, so we don't want to do that. And the second takeaway is, I'm not sure in machine learning you have learned about the elbow method or not. It's going to come even in our course. But that's about cross-validation. When do you stop the learning? And it has nothing to do with that here, but geometrically it's a bit similar. You kind of see that the biggest benefit of diversification happens somewhere here in this area. Right? Because you really go down like linearly and then it starts to flatten out. So it's another rule of thumb that if you have 5 assets, not 5 times the car industry, but 5 assets from a big universe, you have already quite some diversification. And although I say not from the car industry, let me share one anecdote. I was waiting for a plane and there was someone sitting next to me and I saw the person on a conference where we've both been part of. So I started to talk to him and he was the risk manager of a big hedge fund. So it's one of the top 5 hedge funds in the US in terms of assets under management. And he said, it was a few years ago, right? And he said, well, if we are having the theme of investing into gold, we would buy 5 different instruments that make us benefit from if the gold price rises. Right? So this rule of thumb 5 is very prominent. You could have said 20, but this makes little sense. Yeah? So I think 5 is really a good rule of thumb. And this is a way of naive diversification because we are not computing out that 5 is optimal. We just look here at the data and 5 seems optimal. But you kind of see, I like this with the gold example. You have a clear view, you want to invest into gold in that example. So you could say, I just buy one gold ETF or I invest into one gold mine. But there is a bit of risk involved, right? Let's say you go into the gold mine and now there's an earthquake or something in it. That's a problem. That's volatility. So if you have another gold mine, then the demand would most likely go to the other gold mine. So you make up again if for a few months or weeks you cannot dig gold in that mine.
So I think the message for your own personal life is you should, if you have a thought, an idea you are investing into, try to find 3 to 5 investment vehicles that would benefit from it instead of just one. Okay, so takeaway for naive diversification is the risk of a portfolio, so the volatility of a portfolio is lower than if you sum up the volatilities of the components. It has to do, which we will see coming up, with correlation. Okay, how's that achieved? Intuitively, it's that different firm-specific risks cancel each other out. And the rule of thumb, one of the thumb rules, we have 2 thumbs, so I think we should have 2 rule of thumbs here. One is if you have 20 assets, that provides already a diversification very close to the market. And the other one is with the 5. If you have 5 assets, you already get most of the diversification. Right? And that kind of explains why the DAX 40 versus S&P 500. Because the first thought is, wow, I have 500 assets there, must be less risky. Then you look at the volatilities and you see, well, they're roughly the same. Of course, different market, but US, Germany is not that different. So the reason the volatilities are so similar is exactly what we've been talking about here. If you have already around 20 different industries in the index, you get most of the diversification. Okay, now we talk about how diversification happens mechanically, and it has to do with correlation. So think about, we have a bond fund, so that's a risky fund. It's about long-term bonds, like in the case, and then we have an equity fund. If the correlation was 1, it would mean if I start with 100% in the bond fund, and now I'm increasing and I invest 99 in the bond and 1% in equity, I will get 1% of the equity premium. Therefore, on the y-axis, I'm going up, but I'm also exposing myself to more equity risk. Now, the statement is more general that if correlation is 1 between 2 assets, then you do not have diversification benefits. But for any other case of a correlation less than 1.0, there is diversification benefit. Now, put a red box around that, because in a year from now, at latest, you might be tempted to say assets need a negative correlation for diversification benefit, because that seems intuitive, but it's wrong. It just needs to be less than 1.0. If it's negative, it's very good. You have a very strong diversification. But even if the assets have a correlation of 0.999, you still have a little bit of diversification. And here's how it graphically looks like. Let's assume the correlation is 0.3. So it's a 30% correlation. You see, if you have 100% in the bond, and now I'm increasing it, let's say, to 99% bond and 1% equity, I'm increasing my expected return because of the equity risk premium, out of which I now get 1% of that premium because I have a 1% equity investment. But at the same time, you see on the x-axis, we are moving to the left. So we are reducing risk of the portfolio, which is indeed happening because the correlation was less than 1. And Andrew Ng has a book about asset management, and he was also professor at Columbia Business School. Now he is head of ETF strategies at BlackRock, and already for 10 years now. And in his book, he's writing about, has a funny statement, right? He says, think about this shaped curve as the belly of the Buddha, he says. And he says, what you want as an investor is a big belly for the Buddha. And you see that the belly here is really increasing the lower the correlation. So as an investor, you want to find investments that have the lowest possible correlation. It's very difficult to find investments with a correlation of 0 or below. But if you look, for example, the 0 correlation, the analytics are kind of the same. You just have more of a diversification benefit. And if correlation was -1, you could construct an instrument which has some equity premium, so the expected return is above the bond return, but volatility would be 0. And that would be too nice to have. It doesn't exist in industry. But conceptually, this is good to see. And in industry, we talk about a free lunch, and you see what the free lunch is here. The free lunch is the increase in expected return while at the same time reducing risk. So the free lunch is the outcome of diversification. And in finance, we say the only free lunch that exists is the benefit you get from diversifying. That you get for free, so it's a free lunch. And you should not say no to a free lunch, therefore you should always diversify. Now there's a point which we also come across today. It is the point of minimum variance of that belly curve, and this will be called the minimum variance portfolio. Yeah, so it will be the portfolio allocation that results in the lowest amount of standard deviation, and it's for 100% invested in the risky assets. Yeah? D and E are both risky. You see, they both have a volatility. So it's not the risk-free rate. The risk-free rate would be somewhere here. Good. Now there's a systematic way of diversifying, and this results in Markowitz, and that's something you will see. You will come across these two pictures in Python. Ideally, you produce them yourself. And in this example here, let's say on the left, I have two assets. These are individual assets. They have all their own volatility and their own expected return. And what we are computing here, according to Markowitz, would be called the minimum variance frontier. And you see in Python also the algorithm on how to do that. Now, what the algorithm is doing, you see it if you look at the graph carefully here. Minimum variance. So it basically asks the question, how to combine my assets, here these are two assets, such that for a given expected return, I minimize risk. So computationally what you do is you are discretizing the y-axis, and then for each point on the y-axis, for example now this point, you are minimizing portfolio risk. And the portfolio consists of these two assets, the only two we have in the example. And then you get a solution, and the solution then corresponds to that expected return volatility trade-off. Yeah? And then you can construct a continuous curve. And the point, the leftmost point, which looks like it's the black point, but yeah, it comes close, but that's coincident. That's coincidence. Yeah? I think the point with the lowest vol is even a little bit higher, but it's extremely close to it. That is the minimum variance portfolio, or the global minimum variance portfolio, and the entire curve here is the minimum variance frontier. If you want to compute the efficient frontier, that we also do in the Python focus session, the efficient frontier is only the upper part. You start from the global minimum variance portfolio and then everything on top here. And this part here is the inefficient part, which we don't care about because we want to invest in the efficient part. So if you solve first for the minimum variance frontier, you need to know the global minimum variance portfolio so that every other portfolio on the frontier with an expected return which is lower gets discarded. Okay, there's a second algorithm where you could directly just compute the efficient part. And that algorithm has the same problem, but it's looking at the problem slightly differently. You would discretize the x-axis. So you discretize here volatility. And then for each target risk, you are building a portfolio to maximize expected returns. So you change the objective function. And if you do so, you will directly compute everything on the efficient frontier. Now, what you will also see in the Python focus session, ideally you do it yourself, is what happens if I have some constraints. Constraint might be I'm not allowed to invest 100% into this asset here. Or it could be I have a minimum amount of diversification that I need to invest maybe at least 10%, although here you see I don't do it. So kind of any type of constraints you might have, be it a group constraint on different assets together or a constraint on an individual asset. Then can we please be quiet? Now I gave you 5 minutes to talk. I'm really getting messed up here. Thank you. I think you should realize that after 20 seconds it's unfriendly also to your friends next to you. Okay, thank you. Good. Now, if you compute a constrained frontier, you do exactly what we've done with the unconstrained one. So either you are discretizing the x-axis and then you're maximizing for expected return, or you're discretizing the y and you minimize risk. But you will see is that there will be some expected return risk combinations for which you do not find a portfolio. Yeah, so you have dots or holes in between. And that is something that is very prominent in industry. Because in industry, people would always use constraints. And with the constraints, it kind of tells you you wouldn't be allowed even to invest into this point. You cannot invest in that point 100%. You do better, because if you were to invest in that point here, by diversifying, you get higher expected returns for the same amount of risk. And then this would be your frontier. Right. Someone has a thought of why I said in industry constraints are always used? So think about that. That's a good thought to do. Okay, here I gave you now the two algorithms I was talking about for getting the minimum variance frontier versus getting the efficient frontier. Okay, so how to find now the tangency portfolio. Now, visually, the tangency portfolio, it requires us to know the risk-free rate. So let's say I assume something here, maybe 4.5%, and then we need the efficient frontier, which we now have, and then I make a connecting line with the steepest Sharpe ratio. Yeah, so I would find here the point on the efficient frontier with the highest Sharpe ratio. Double check again why on the efficient frontier. Everything above the frontier is not possible. Everything below the efficient frontier is inefficient because I can do better by systematically diversifying, and then I get onto that efficient frontier. So therefore you either computationally compute the efficient frontier, and then you have maybe 1,000 dots. And next would be you check what's the Sharpe ratio for each portfolio, and the argument with the max Sharpe ratio will be your tangency portfolio. Another way to do that is more brute force. You simply write down what's my objective. And my objective is I want to maximize the Sharpe ratio. And the degrees of freedom you have are the portfolio holdings, W1 to Wn. Right, so that's another approach to do it. Independent of which approach you use, you will come up with a portfolio vector, W1 to Wn. And that will tell you how to combine these risky assets such that the resulting portfolio has the maximum Sharpe ratio, therefore it's called the tangency portfolio. Since we have expected returns given and volatilities and correlations, we can also then compute the expected risk premium of the tangency portfolio as well as the variance. And then we're good to go to the second step, which we talked about. Good. If we now combine these two steps, so we found the tangency portfolio. We go back to our red box from previously. So we know that every hospital is going to invest into the tangency portfolio according to this formula here. If the Y, let's say, would be 80%, so you go 80 into tangency, 20 risk-free, then your final allocation would be the 80% times your tangency allocation, which is W1 to Wn. If you add everything up here again, this adds up to Y, to my 80%, because the W's add up to 100%. And then 1 minus Y will be the risk-free rate. So it's what we call the money market account, or here the treasury bill with a short-term maturity. So it could also be that 1 minus Y is negative, because if Y is, let's say, 120%, then 1 minus Y is minus 20%. It would mean that you have to borrow 20% of your investment at the risk-free rate to invest 120 into the market. That is something equity does, investment firms like private equity does it, hedge funds do it, right? They all have low risk aversion, and their optimal solution would be to lever up, to borrow money and go all in into the risky asset. Good, let's just finish up. Here's a summary slide on the entire allocation approach. So let's just summarize it. Let's assume D and E are your two risky assets. What you do first is you compute, according to Markowitz, the minimum variance frontier. Everything above the global minimum variance portfolio will be the efficient frontier. We know that the tangency portfolio will be on the efficient frontier. How do we get that? We are simply finding the efficient portfolio with maximum Sharpe ratio, which is here P. And now we have an investor characterized by his mean variance utility function, which translates into the indifference curve. And that investor wants to maximize how well he feels about a portfolio decision, and therefore he finds the point of tangency between the indifference curve and the capital allocation line. Okay. Good. Now there are some implications. Implication one is that the tangency portfolio will be the same for all clients that a portfolio manager has. It also means that risk aversion is the only criterion which is different among investors and which is the reason of why the portfolio will be different, which they are holding. And the more risk averse you are, the closer to the 0 point you are on the allocation line. but the resulting Sharpe ratio will be the same than if you are a hedge fund who is positioning himself further to the right. Okay, and that separation between, on the one hand, the tangency portfolio, and on the other hand, the optimal complete portfolio, is what is referred to when people talk about two-fund separation. Yeah, kind of, we are separating the portfolio decision-making process into these two funds. Okay, I just finished that up, and then we go into the break. The separation principle means, therefore, every investor will find the tangency portfolio. The investor will determine what's the risk aversion of the client, and then match these two things according to the allocation line. Good. And what we do in the remaining will be, we are visiting the case study and play around to sharpen our intuition on portfolio allocation. So thank you very much so far.